We are live in another
Yeah.
BYOB Ask Me
Yes.
Anything Wednesday, and excited to be here with you guys. Another week of helping free people. Everyone wants freedom. We all want the same thing, some version of our own freedom. So it's nice to share stories with people, the wins that we're having, and also have people really admit to where they are today, because that's where your freedom starts, is really being honest with yourself and taking the steps forward.
All right, we got a couple questions here.
Yeah, let's dive into the questions. Yeah,
With
sorry about the
Stevens.
weird start, but we're going to just get right into it.
That's okay. Megan Stevens has, being new to the insurance industry, I'm learning a lot of things, and most recently the IBC concept. The problem I am having is figuring out when I would use IBC versus other traditional insurance. And then she has a second part. She goes, I hear IBC is not for everyone. Can you give good examples on when you would suggest to them that perhaps other run-of-the-mill insurance options would be better?
I'll say like one example is like we always say term insurance isn't the best. Term insurance is very is profitable for the insurance companies, etc. But it does have its place. So like I've had people that I've been talking to recently where they have like a business that has some significant funding for about 2 to 3 years, and I tell them, hey, it's very cheap to get a term policy for a short period of time to cover that debt. So in case something happens to you, that debt is covered. That's a great example of using a term policy to cover a specific limited kind of issue. So that's a good example right there.
Yeah, I mean, I would agree with that for sure. And being new to the insurance industry, I don't know if you're new, meaning just getting exposure to the insurance industry, or you're new as an agent. But IBC concept, the infinite banking concept, is an amazing concept, but just like you were kind of alluding, like it's not always right for people. And the first thing I would say is, the infinite banking concept, the process of taking back the banking function, takes somebody who wants to change, somebody who wants to take back control. So I'd say that's step number one. Step number two, takes somebody that is actually saving money today, because we can't make money out of thin air. So they got to be saving money. What's that?
Unless you're the Fed.
Good point. Unless you're the Fed and you're running a fiat, currency business or a fractional reserve banking type of operation, which we're not even going to get into that. But so most of you, if you're going to do the infinite banking, you have to be saving money, because remember, we're changing one thing, and that's where your savings goes first. And number three is really the use case. I mean, I can't really think of many use cases where there isn't a use for the infinite banking concept, because your money's always going somewhere. You're buying cars, houses, investing, doing all those. So just change where the money goes first, and then invest, buy cars and housing, but do it in your own banking system instead of using the traditional banking system. But I definitely will say, like, although term insurance is the most profitable insurance for the insurance company and the least advantageous for the people buying it, even though it is the highest sold and the most sold life insurance because it's cheap, I would always reference to people, I just did a YouTube video on this, when it comes to the most important things in life, we're always saying, well, what's the cheapest? What's the cheapest? What's the cheapest? What's the cheapest? But in your life, do you actually buy everything that's the cheapest? Do you drive the cheapest car? Do you live in the cheapest house? Do you wear the cheapest clothes? Do you wear the cheapest sneakers? Like, do you go to the cheapest restaurant? I mean, because if that's how you live your life, then yeah, perfect. Then IBC is definitely not for you. Term insurance is. And I think term insurance has a big fit. I own term insurance, but I own term insurance for what its intended purpose was. I bought a 30-year term insurance policy for $1 million. 30 years. Can anyone guess what I was protecting in a 30-year time frame? How about a mortgage, right?
Mortgage?
Yeah, I took out a mortgage, and I had a lot of mortgages with our real estate business, and I took out a mortgage or a term policy that covered my mortgages. Should I die, all the mortgages would have been paid off. So when you buy term insurance, it is not permanent coverage. It's renting the insurance for a period of time. Make sure that you're renting your insurance for a specific need that is for a term of time, like a car loan, student loan, a mortgage. Don't do it just to say, oh, well, someday when I die, I want to make sure my family's protected. Term insurance will fail you every time on that.
Yeah, and Chris, I guess I would kind of add to that piece of it. When Megan asked that question, where I was kind of thinking is, we need to have a banking function in our life, but we also have the need for income protection or protecting our families. So I'm thinking in terms of the and Joe loves the word and, but if you set up a banking system and it doesn't have enough death benefit to cover the other piece, which is the income protection, term can be a good gap filler there. And guess what? You can convert some of that term over time as you get more income, or however you want to do this. You can start converting some of that term into whole life, which then increases your permanent death benefit. So there's a lot of cool strategies out there. So I wouldn't look at it as it's either this or this. I would look at it as this and this, and how do they work together.
And that was the first thing I thought of when I saw Megan's question, is that she's talking about when would she use, money? When is she going to need money in her life to do anything? And I was thinking, like, for everything. Like, that was my first thought. It's for everything, single thing that you're going to buy, that you're
brand new to the insurance industry, learning a lot of things. Most
are going to do some kind of money for the most part, unless you're stealing, right?
But we do have a bunch of stuff over here on Instagram, Shauna. So before we move to the next one, can I just rapid fire some Instagrams?
Sure.
Yeah, I want to make sure I give some love over here. No Name 85M. What happens to Ripple Select case? I would think like that's a rated select case is maybe what they're trying to say. I don't know what a Ripple Select case is, but in the infinite banking concept, the way we're designing these policies, we're designing them for the highest cash value and the highest early cash value. We're not designing them for the maximum death benefit. So if somebody gets a rating that isn't a preferred or, one of the higher ratings, let's say they get a rated case or, like a select standard or something like that, something like a smoker, it doesn't affect the policies we design nearly as much as it would affect the premiums on a term, the premiums on a regular whole life, because remember, we're reducing the death benefit down to pretty much the lowest levels we can for the IRS rule called Max 7 pay. So if that was the question, that would be the answer. Justin Bird 9828 on Instagram said infinite banking concept ? So we got to kind of roll it back. I'm not going to spend much time on this, Justin, but that's what we teach. We teach people how to set up private banking systems. It's known in today's world as the infinite banking concept, pioneered by the late R. Nelson Nash in his book, Becoming Your Own Banker. But basically what it is, it's simple. It's you take back the banking functions in your life. Everything that you use a traditional bank for, you take back control of all of those things, like financing your cars, your houses, where your money goes so that you control it, making the spread like the bank does, because the bank pays you interest and lends it out at a higher interest rate, making a spread. So that's what we teach. So that the infinite banking concept, quite simply, is the process that we teach, not a product, it's a process. I had one really good question. Duke right here. I kind of like this one. And I guess I want to go around on this one. What's the highest level exit strategy you've seen infinite banking be used for? So kind of a weird question, Duke Wayne official. I don't really know what you mean by exit strategy, but the biggest use case that I've seen was a real estate developer, and they did a $2.2 million dump in, and they immediately deployed that capital so they put the money in the policy. I literally think it was like 3 days after the deposit was made. They took the money back out and rolled it into a real estate deal, which they then completed and sold for a huge multiple. I don't know what the percentage return was. I knew the dollar amounts. It was significant. So if that's what you're asking, that would be what I would say there. Anyone else have any big exits?
I'd say most exit strategies in whole life is when you pass away.
That's what I was thinking. Like maybe he's asking the biggest death benefit.
Yeah. So I don't know.
God.
I don't know if that's what they mean, but that's kind of where my mind went.
I've delivered so many death benefits. I haven't delivered any of the huge ones, but we have death benefits on the books in the tens of millions of dollars. So, when we pay those out, those will be the largest exits, if you will. But luckily, those people are still with us. Thank God.
After my aha moment of not running the money through the policy as a dump and losing that money in interest, since 2019, I've already lost $50,000 in interest because I didn't run that 150 through.
Yeah, there you go. So that's a big loss. Duke Wayne official again said, can I use term insurance as collateral for an SBA-backed loan? No, term insurance can never be used as collateral because there is nothing to collateralize. Term insurance is just protection. It's just you're renting the insurance. There's no cash value. You could use a whole life policy like the ones we design 100% for collateral. It's done all the time. Matter of fact, I wish Brandon was on here. We just collaterally assigned my policies just recently. So those can be used, but term insurance is just protection. So in the form of an SBA-backed loan, where the government or the issuing bank for the SBA loan would require term insurance would be not for collateral. It would be for protection. If you die, the loan gets paid off. So totally different use case, and I wouldn't call it collateral. But Shauna, let's come back over to you. I'll keep an eye on the questions coming in from IG, but let's give some love over here to Facebook and also YouTube.
I'm going to start at the bottom, actually. Zach had a really good question, is why does whole life insurance even exist? It doesn't appear that someone who pays into a policy for a lifetime never gets close to the payout from the death benefit. So what's going on there?
All right.
We'll just
Don't anyone attack Zach. This is a legitimate question here.
It is.
I mean, yeah. So you're looking at it completely wrong. So why does whole life exist? Well, first off, whole life was the original, the OG life insurance. It was the first life insurance ever. So why does it exist? Well, because it was the only life insurance you could buy when it came out. Term insurance, universal life, all these other insurances came after whole life. So that's step number one, or strategy, or answer number one. It doesn't appear that somebody who pays into a policy for a lifetime ever gets close to the payout for the death benefit. Well, that's because it's designed that way. You could never have more cash value than you do death benefit, because it would be an endowment. You can't do it. So as your cash value increases, your death benefit goes up. That's how it goes. So the more cash you have in the policy to use, the more death benefit you have. And it just keeps ratcheting up. That is absolutely how it has to work. So you can never have as much cash value as death benefit. And why would you want it? Why would you be buying life insurance if that were the case? If you're putting money into a whole life policy, and remember, there's lots of different use cases, but let's just tackle it just as life insurance as a whole. Like, you want to put the least amount of money in for the most amount of coverage, right? For your whole life. Keyword, whole life. Like, term insurance is way cheaper, but it doesn't give you protection for your whole life. Whole life insurance, like its name, gives you life insurance protection against your death for your entire life. You can't outlive it. So right there, that's why it exists, because it's pretty much, the OG, and also one of the only ones that basically has guarantees that will pay that death benefit till the day you die. So what's going on there? What's going on is you have a lot to learn, Zach. I'm not saying that in a bad way, but you have so much to learn. If that's what's going through your head, you've been brainwashed or misinformed, or maybe you're just at the early stages of your learning curve. So I would say, rewind, go back to the original root cause, or the original root evolution of whole life. I did a video called The History of IBC. You can start there and then forward through, and then you'll sit there at the end of that and say, well, why is there any other life insurance than whole life?
Yeah.
I love that frame you offered in the end. I didn't read the question that way. I was kind of scratching my head, thinking that someone pays into a policy for a lifetime, never gets close to the payout. I'm thinking, wait a minute, like anything we've designed, the death benefit is a multiple of whatever cash has been put into it.
Yeah, Jason, and on that, one other thing, gosh, I can't believe I forgot this. There's not a whole life out there that I've ever seen that you won't eventually, in time, have all the money back that you've paid in for the policy. In other words, like, you pay your premiums in and your cash value increases. And every whole life I've ever seen, at some point in time in the future, you will have gotten all the money you paid in. And once that happens, it can't ever go backwards. It's guaranteed not to. So you'll always have more cash value than you do premiums paid in. So that means you make money for protecting yourself and your family for life. Like, in the ones we design, the specially designed and engineered ones we build for whole life, Craig, what's the average, or the majority of the ones we design? Where's the break even? 6-7 years?
I mean, it could be anywhere from 4, 5, 6, somewhere in that ballpark.
Yeah, 4, 5, 6. So you put premiums in for 4, 5, 6 years, which you have access to a large percentage of those premiums in the cash value that you put in. So after 4 years, 5 years, 6 years, you've gotten all your money back. Literally every penny you've gotten that you put in, you could take it all out and you could be ahead of the game. But then for the rest of your life, okay, so if you think, if you're 30, you're now 30, let's just go long. Let's go 36 years old. How long do you think you're going to live? You're going to live to 75, 80, 90? Maybe you're like someone that just hangs on. You're going to 100. Like, how much money will you have made in all of those years after the 4th, 5th, or 6th year? The numbers are staggering. I'm not even going to attempt to give you numbers, but maybe that's where you should start too, because it's single-handedly one of the greatest assets you'll ever own in your life.
I think Zach is asking the question the other way, is like, why would the insurance company actually do this? Because aren't they losing?
Yeah, and why don't we take it
Yeah.
back to hundreds of years ago of like when, you know, it was to protect families and its income and it was communities and that type of thing. I think we're a little too forward facing with just speaking IBC.
I mean, it was really
that's a really great freaking question. Now that it's framed differently and I'm understanding it different, that's a freaking amazing question. Because Craig, he's asking, why would an insurance company ever issue a whole life when literally it seems like they can't win? But absolutely they can. They have actuaries that can tell you when you're going to die or when a large group of people are going to die. So therefore they can calculate exactly how much in premiums they're taking in, and those premiums compounding over time. That's the key word, compounding. So they put that money to work, just like we teach. Like they take your premiums and everybody else's, they put that money to work. And they know conservatively that money's going to earn 4 to 6%. But 4 to 6% compounding over, holy crap, I mean, 40, 50, 60, 70, sometimes 80 years is massive, massive. And you're also not factoring in that, you know, they build into there the amount of people that are going to lapse their policies. So that's factored in because now they got all those premiums to work for them. And all they had to give back were the cash values, which was basically just a component of compounding interest. And they never had to pay the death benefit out. That's why term insurance is so profitable. They never pay the death benefit out, less than 2% of the time. So that's a great question, and I'm sorry to monopolize these questions, but that's a freaking
no, but it's like the risk pooling idea is really what's going on there. Is they've got a bunch of people piling their money together, covering, and the insurance company, like Chris mentioned, they've got actuaries that have this figured out to a science. They can, you know, pretty much tell how many people are going to die in a year, how many of these people are going to die, and you know, sometimes they're a little bit, you know, they miss it on the positive or negative side, but over a long stretch of time, they're accurate. So, but then I'd also say, and Chris, you've already touched on it, what are some of the higher profit products in an insurance company? It isn't whole life.
IULs and term are the two highest profitable products that life insurance companies ask. That's not my opinion. That's from the horse's mouth. And I'm not going to give names, but let's just say we know the CEOs and the presidents of these insurance companies, and they're very open about it. Yeah, term is the cash cow. IUL is the cash cow. Because they put all the risk on the client, not on the insurance company. They love those freaking products.
Yeah, and what's the generic, you know, payout percentage on a term policy? Isn't it like 2 to 3%?
Less than 2%. You can everybody can look it up. Just Google it.
Yeah. So.
Yeah, and
Zach,
Zach,
that was a good question.
Zach, I hope you didn't feel you were getting roasted or on the spot.
Sorry, Zach.
We were just answering, speaking into what's out there for you. We get very, very excited.
We're just passionate about this shit, right?
We're getting excited about opening people's eyes to what they're really not seeing. It's like, you know, the famous saying that we talk about all the time. The problem in America isn't what people don't know, it's what they think they know that just ain't so.
Well, that was a great question, Zach. So I'm glad you asked it because it really brought up a lot of good discussion. So like Jason said, hopefully you don't feel too roasted, but not our intention, just passionate people.
And tomorrow at 3, I'll be talking about how we build kids policies, and like this will piece in 2 questions that were asked today: is how we build kids policies, grandkids policies, why we build them, what they look like, how you design them, how you engineer them. One of the questions earlier is why would you use a term, right? I have a person who's starting. She's in her 60s. She's starting her infinite banking journey. She's got 2 grandkids from her 2 daughters who are completely opposed to having any insurance, right? But she wants to start policies for them. So the only way to do it would be to put convertible term on the daughters in the amount to reverse engineer it back to the kids, right? So there's another interesting way to use term. And so that's something we've been exploring to build that security around her family, right? And do it in a way where they could eventually learn this and convert it into that. And then as far as like what we put in and how much is available, like the one, I'll be going over actually real numbers from our son's policy, our youngest son's policy. And I think 30 years, I'm trying to look at the numbers, 30 years into it, we'll have a total of like 230,000 in the policy. And if it just works like it's illustrated to work, which it'll work better if we bank with it and pay back more and do the things you do with banking, but there'll be $430,000 of cash value in that policy contributing $430,000 in the 30th year. So the uninterrupted compounding interest that's growing tax-free. I mean, that's part of what Zach wasn't asking, but we thought he was asking.
So Casual Credit Gaming is saying, hi, assuming you have a non-steady income and you happen to have a down year, you have a policy loan out you intended to pay off. Do you prioritize maximizing PUA or paying the loan? And then a follow-up is just assuming you only have the cash flow to do one or the other, which is a fantastic question.
Awesome.
I like that question.
Let's let everyone else answer that. That's a great question. And we'll be right over here to Instagram in a second. So keep those questions coming in. They're good ones.
Yeah, this is I had a client like this yesterday. They have actually there's income written down recently, so they're asking, hey, if it happens again, what are the options? So, I mean, the first option is you can always reduce the PUAs. So that means your payment or premium goes down to around 30-40%, and the policy stays active, and then you can typically catch up the PUAs within that calendar year if your income comes back up. That's option number one. Anybody else want to take the second option?
I think they're asking more, what should they do? They're saying, should we pay our policy loan back, or should we go and try to max our PUA for the current year?
PUA.
I want to say, why can't we do both?
Well, you could, but I think he's saying he's only got enough money to do one or the other.
The same amount.
Craig,
really
why PUA? I want to hear why PUA first.
Well, I don't want to just say PUA. I would want to see it, and I'd want to just look at the math. Like putting a PUA in, what's the return on the PUA versus what would you pay for the loan? I mean, I'm going to take one from Craig's book. Math solves all, right?
That's what I'm going. That's why I'm asking Mr. Sheets. Why is he saying PUA?
Well, if you look at the long term, you want to get the PUA in, because then that full amount's going to compound and grow for the rest of your life, assuming you're the insured. Now, there's always edge cases. Is your policy in danger of lapsing because your policy loan hasn't been paid in multiple years and it's compounding and interest is growing? So we'd want to look at some of that. But I would say, if all things equal, if I had the option of putting in PUA or paying the loan back, and that's all that I had is enough to do one or the other, I would be looking more towards the PUA. But there are some edge cases where it could change that.
I guess my question is, wouldn't you be able to put it into the PUA, borrow it back out, and then pay the loan? Why wouldn't you be able to do both?
It sounds like he's talking about a loan to the policy, though. At least that's what I was assuming.
That's what I was assuming too.
Oh, I thought he meant.
Joe.
Interest.
Yeah, what you were thinking he's saying paying an outside third party loan. That then, your point, put the money into the PUA, then take the loan out and pay the higher interest loan. Yeah, but we don't know enough detail, so we were just assuming that loan was a policy loan that he has out. And in that case, I'm going to go with Craig. Craig knows the math. Like, listen, you all can have your opinions, but Craig's already done the math because he's got a spreadsheet for that.
I concur. Then I concur. Now that I know the question.
That's what the cup says. I've got a spreadsheet for that.
Yeah, I've been there where I couldn't make the full POA payment, but I always made sure to pay my base, like Brent's always taught. And then I was able to catch up a couple weeks later. And I actually have not paid any loans back on that policy. I've always made sure to pay the interest. And I'm in the 6th year, and I'm looking at my policy illustration now. It's supposed to be at $104,000 for the net cash value. But my statement this year came at 108. So our money still grows, and I always make sure to pay the PUA. And now I just got a refi from a burr I did, and now I can pay the whole thing back, or I'm going to use it to start a new policy. So I'm in the middle of that now. But yeah, you can always just.
So Gabe, are you saying you haven't paid any loans back since you've had the policy?
Correct.
Okay.
Yeah, I've been using that just to reinvest it into the school, put the money to work, to my jiu-jitsu school and my businesses. So I haven't paid any policy loans back.
But you paid the interest, though.
Pay the interest, yeah.
Now, Craig,
I don't want that to eat into the cash value.
Thank you for pointing that out. Because as far as being an honest banker goes, that's like the minimum requirement we teach.
Yeah.
Now you don't have to, because I hear Chris
saying.
I've never ever said don't pay the interest.
No, but you've said you don't have to, because it is true.
You don't have to. The insurance company won't ask you for the loan to be they won't send you a bill. Oh, pay, you owe this loan. Like they'll bill you for the interest, but to the insurance company, they're psyched that you don't pay the loan back because they get the interest on it.
That's why I opened the can because I want to make sure that we're very clear in what we teach.
Well done.
Yeah, I thought I said that. Sorry.
So Craig, what's the math behind that? Wouldn't you prioritize paying the policy loan interest before maxing out the PUAs though?
Wait. Listen to what he said. Wouldn't you prioritize paying the policy loan interest before the PUA? Yes, but not paying the loan back before the PUA. Well said. See,
I believe when you send the money,
your own team members getting you on a technicality.
I believe when you send the money to the insurance company, that's the order they attribute first to the interest and then to your premium. I think
Correct. If you were on an annual premium mode and you got your premium notice and you sent that in, they're going to take, if you sent one check in for it, they're going to take the interest first, and then the rest is going to be applied to PUAs after that. They're always going to prioritize their loan interest.
Okay, I got 2 comments that I'm just going to read off real quick. One question, and then we'll go to Instagram. So first, shout outs just to Fern. Hi from California. Just signed my first policy. Can't wait to get my BYOB journey started. Looking forward to live events coming up in the next few months, taking the accelerator course and the bus tour. And I believe we'll probably see a money tank, I bet. And then Navigate Your Venture said, shout out to Jason Sipple and his channel. Looks solid and your principles are great. Even did my first cold plunge sequence a week ago. And then here's our last question, at least from YouTube right now, is, okay, I'm in the process of setting up my policy. My question is, how do I look at my recently started business to pay for it or another one down the road?
Oh, wow, Hefe, that's an awesome. We actually did a whole wealth webinar today, very similar to this question. So, depending on, here's what I always tell people, depending on your needs and goals and where the money's coming from, kind of helps you determine whether a policy should be personally owned or owned by the company. Typically, the way I delineate that is if my income, my personal income or my personal savings is what I want to put in the policy, it's going to be a personally owned policy. But if I've got business owned policies that are using business money, and the reason for that is I don't want to take the money out of the business because then I got to pay tax on it, or it's a distribution, or I got to go into my retained earnings. So I keep the money in the company. I have the policy owned by the company, and therefore it just becomes a balance sheet item. I'm just moving money from my checking account into the policy. It's just literally just a flip on the balance sheet. So now instead of cash in bank, it's now cash value life insurance. But now what I've done for the business, I've protected my life and my human life value for that business. So that's another important thing. If you've got partners or things like that, you should look at buy sells. But realistically, it just comes down to where the money resides that you want to put into the policy. If the money resides in the company and the needs and goals are for the company, then the company should own it and you should just be the insured. If it's personal, like you want to buy cars or debt or anything personal, then personally own the policy. That's how I delineate it. I mean, if anyone else has anything on that, go for it.
Solid. I've always heard Brent say that for the most part, unless you said like you want it inside the business, he always talks about how you don't want to have your business owning an appreciating asset. So is there any further? Because if you're like new starting a business, like it was a Hefe means boss, which I love that tag, right? So if you're starting a new business and you don't have cash flow yet, but you want to have it inside the business, then does it really make sense to have an appreciating asset in there?
I don't think there's a problem having an appreciating asset inside of a business. I mean, many businesses have appreciating assets. Hell, businesses are appreciating assets if you really run the business the right way. So I don't really know what Brent says with that. I think having an appreciating asset inside of a business is actually maybe a really smart thing, because now inside that business, you can have write-offs against that appreciating asset. There's lots of reasons to, or lots of reasons not to have the policy owned by the business and have it owned personally. I mean, most of my policies are personally owned because that's I'm trying to personally protect my life for my family, and I'm also using personal savings and personal income. But now very recently we've been kind of looking at it more from a business standpoint and saying, hey, we got a lot of extra reserve capital in the business. Maybe we should start putting that through policies. So that's kind of how we're starting to look at it.
Is there, and you always make such good distinctions about how you look at things and like what the job of each thing is. Would you say that is based on a certain level of disposable income sitting income inside the business? Like you're kind of looking at like, okay.
I'm pretty weird, folks. Like, and you kind of have to get in my head a little bit more, but like everything in my life is little silos. So, and Shauna knows this, like in the, and I'll just speak on the business world. My personal world's very, very much the same, but in the business world, like we have our operating bank accounts. So every business has its own operating bank account. Every real estate property has its own bank account. So silos that kind of silos all of the money for that particular company or that particular property. Then on top of that, each company, what we try to do is we try to set up 2 different accounts. And this all comes from the book Profit First. If you haven't read the book Profit First, this is where this comes from. I always will have an account in the business called a reserve account. And what that's for is, some months you have more cash flow issues than others. So we keep about, my minimum in the reserve account is 25. We're sitting on about 100 right now, but 25 grand in the reserve account is my bare minimum. And what that's there for, and how did we come up with 25 grand, is I know payroll runs about 25 grand a month. So if I have a month where things are really rough, I can cover payroll right there from that reserve account. So 25 grand minimum, but right now we're sitting a little more. And I think we're going to bump that minimum as our expenses go up in the business, because we're growing. We're going to increase that to 50 grand. That's the minimum. So anything above 50 grand is money that needs to be placed somewhere else where it's going to earn better. Secondarily, I have I call it a war chest. You can call it whatever. I call it a war chest. That's like excess money. Every quarter we put money in the war chest, and that money's for down the line if I want to buy out another agency. Like there's another IBC agency and they don't want to do it anymore, we'll buy them out. We want to buy another business that complements what we're doing, or we want to buy another building, or open an office in Florida. The war chest is for that. So the war chest, like that money is almost always out there working for us. So we've got that money in treasuries. We've got that money in back when inflation was high. We got it in I bonds. We got that money lent out to some of the lenders on Private Money Club. So the war chest, my number in my mind is 100 grand. I mean, we're far exceeding that now, but 100 grand is what I like to see in there as a bare minimum. That's just my personal need. Silos.
So I'll add to the equation that he was asking about is when should I have a personal versus business, and we've discussed some of this stuff already, where on the personal side, if you've got the need to buy cars, finance major purchases, pay debts, of course makes sense to do it on the personal side. If you're using that money internally to the business for buying additional business equipment purchases and whatnot, it makes sense to have it in the business. But there's more to the story, because if in the business, let's say that you've got partners, you might want to start thinking about, not only do I want to have a policy for financing the things you need in the business, but how do I protect that business if one of the partners passes away? How do we sustain the business by paying out the other business partner? What if I lose a key employee? So all of those strategies inside of the business, whether it's key employee loss, a buy-sell agreement, those types of things, you can still have a policy in the business and use it to finance the equipment things that you need. So those are important considerations too. Now, with your business just being brand new, I don't imagine you'll have any of those, but that might be something to consider down the line.
Let me hit it from a different aspect. If your business owns the policy, your business has to pay the policy.
Good point.
So you also have to make sure, if you're brand new, you can't take it from your personal account and pay the insurance company, because they want it from the business account who owns the policy. So I would always start on personal side, like I did, and then 3 years later, then I transferred it over to the business, because now I know that the business has enough income to put money into the policy. So that's another for accounting purposes.
Good way to look
I
at
like
it.
we're making this like a paint by numbers. This is perfect, like with Chris's, and then good stuff.
And before we switch topics to
Sure,
Instagram, because it's the same thing, same topics. If the policy is a business policy, do they still have to go through health qualification?
Yeah, we got this a bunch today at the Wealth webinar. The answer is yeah. The underwriting guidelines are exactly the same, whether it's owned by a business or personally. I think a lot of people maybe ask that question because they're used to guaranteed issue group policies. So it might work for a company and they can buy a whole life and there's no underwriting. That's a group underwriting. Take a look at the cash value on those guaranteed issue. It is non-existent. Those policies are actually dog beep because they're guaranteed issue. Like they're taking excessive risks. So guess what they're doing? They're stripping all of the good stuff out of the policy and giving you just the bare bones because it's guaranteed. So it doesn't matter whether you got a year to live, maybe, you just heard from your doctor, you got 2 weeks, like they're giving you a policy. So they're factoring that in by literally stripping the policy down and making it very inefficient.
The owner does not matter of the policy.
Correct.
Is what the one thing that can't change from the policy from start to finish is the insured. And that person always has to do the health.
All right, can I
something
flip
else
over?
I would-
Go ahead, Linus.
Yeah. So something else I would put out there. Now, I'm not an attorney, but if you have the policy owned by your business, now it's a business asset. And if that business is doing business with the public and the public is sue happy and get sued. Now, I'm not sure if in a lawsuit, if it's a business owned policy, if it can be touched, or does it also have the same protections a personal owned policy would have?
Yeah, we'd have to check on that. I'm pretty sure it's going to fall under the same protections. It's state by state.
Yeah.
People always ask me that. Well, what states? What are the protections in what state? Like, just Google life insurance. States life insurance is protected from judgments and liens. I did that the other day, and the first website that comes up literally breaks down every state and what the thresholds are. Like, Florida's unlimited. Clearly, New York is not unlimited. So you can almost just look through. I mean, red states are one and blue states are another. So I'm not going to say any more. It is literally what it is. I don't mean to call that out, but like I looked at it the other day and I'm like, whoa, this is kind of eerie that it's like all these states have really crappy protections and these states look like they're awesome.
That's just your powers of observation. You make good observations, Chris.
What's the best advice for a new agent in the industry and doing IBC? What would you all say?
I never think of myself as an agent, number one, right? Like I think if you're doing, we're doing IBC, and I really look at it as being, we're giving out the best education for free. We're really here to serve. We're really here to solve someone's problems. And the questions that we're answering are always based on what someone's needs are. So like whatever you're doing, no matter what you're calling yourself, I would think about it as, how can I go and either speak to more people, share this message more, make more impact, solve more problems, and go from there. And you surround yourself by those people that are going to have that same vibration. So,
I'm in the education field.
Yeah, that's how I got into it. I was doing financial education and literacy, working with Robert Kiyosaki's personal advisors. And so I was talking to those advisors, and they were coming onto my platform and sharing, and that's how I heard about it. And I realized this is a massive solution to a huge problem out there. And so I approached it from, how do I share this solution with as many people as possible? So I built a course on infinite banking that teaches infinite banking to people. I wasn't even licensed yet, but then I realized, well, if I'm going to talk about it, I better be licensed so I can learn more about it, so I can talk intelligently about it. So that's the second phase. And so that's how I got into it. It was really about trying to share with as many people as possible.
That's awesome, Brian. And Joe, I thought you were just in the business of clicking and popping. I didn't know that you taught stuff too.
That's in my head with the numbers.
Anyone else?
Yeah, I guess I would just add, do it yourself. I mean, practice it yourself, learn how to do it, fall down, skin your knees up, just like riding a bike. You want to learn how to experience it yourself and see how it works. And then you can go out and teach it.
Yeah. And have a good why. You have to have a good why.
Yeah.
We're all here because we have a similar why. Like, we didn't know each other a couple of years ago, 2 years ago, 3 years ago, right? But when you start with that, like, you read Nelson Nash's book or however you got introduced, and you're like, this can't be true. If this was true, every single person would practice this. And when you start from that point and you start getting really curious about it and you continue being curious, you continue learning, this is never ending. Like, I learned something going through the Nelson Nash practitioner thing the other day, that, when you're listening to someone's a PhD economist teaching it, he's like, yeah, every time your dividends buy a PUA, it gets more cash, more death benefit. What's really happening is you're buying an additional policy, 1 year policy inside the policy that's stacking year after year. I'm like, oh, so those light bulbs will continue going on, and you'll keep rethinking your thinking. Then you'll end up around this group. So that'd be my best advice.
All right. Linus, do you have anything on that?
I did, but you guys covered it. I actually went and looked up the definition for practitioner, and it fits exactly what Craig was saying. And then, I just wanted to encourage this guy, I don't remember the name, to go through the Infinite Banking Practitioner Program on the website infinitebanking.org, which is the Nelson Nash Institute. A bunch of us are going through it. I haven't been through it yet, but it's some really good stuff.
Well said. And WindyNet 75, the best advice I'd give you is don't sell anything. Solve a problem for somebody. That's the number one thing. If you do nothing other than go out there with the intent of solving problems without trying to ever think about, how do I sell? Stop selling, start solving problems, start teaching the process, because the infinite banking concept is a process. I promise you one thing. You won't ever have to ask for business again. But also, and they already said this, but I'll reiterate this, you can't teach the infinite banking concept if you're not using it in your own life. That is critical. So that's some good advice for WindyNet. Let's get down to the next question here. Within IBC concept, when you take loans out, does the interest go back into the cash value? Let me just hit this one. Like this is probably the most complicated thing about the infinite banking concept, because you're really talking about 3 different interest rates. So let's break them down. Number one, the guaranteed interest that the insurance company charges you, interest number one. Okay. The interest rate that the insurance company charges you on the loan you take out. Now, here's one thing that's important. The dividend crediting rate, which is the guaranteed interest plus the dividend of the policy, should always exceed the interest that you're paying on the loans. The gross dividend crediting rate should exceed the interest you're paying on the loan. The reason I bring that up is it almost seems general practice that most people think, oh, well, all policies do. No, like companies like Northwestern Mutual do not. The interest rate to borrow is more than the interest you're earning on the policy. So they don't all work. So interest one, guaranteed interest on the policy. Interest two, interest you're charged on the loan. Interest rate number 3, the interest your money earns when it goes out to work for you. So when it goes to investments or real estate or lending or buying cars or paying off debt, like that interest rate needs to be greater than the interest charged on the loan. So back to the main question, with an IBC concept, when you take loans out, so we're going to assume these are the loans from the policy. Okay, so those loans right now for the companies we use are about 5 to 5.5%, maybe we'll say 5 to 6%, just to cover the base. Okay, does the interest go back into the cash value? The interest charged on the loan does not go back into the cash value. That interest is paid to the insurance company. That is the actual interest you're losing. However, the way we design the policies in the companies we use are called non-direct recognition, which means they don't recognize the loan. So let's just do simple math. You have 10 grand in your policy. You take 9 grand out. How much money is left back in your policy earning interest and dividends? Most people would say $1,000 because they're used to banks, but non-direct means they don't recognize the loan. So you still have $10,000 earning that dividend crediting rate, that guaranteed interest rate plus dividends. So you are exceeding the interest charged on the loan there. After a couple of years, the first couple of years, no bueno. Like you're losing the first couple of years because the interest paid on the policy hasn't really started compounding. So you'd be at a loss there because of cost of insurance and the other costs in the policy. But after usually year 2 to year 4, you're at the efficiency point where you're earning more than what you're paying. So that's the key of understanding is you're trying to make a spread. Banks, remember, being your own bank, like learn how to take back the banking function. What do banks do? They make a spread on money. They pay you an interest rate. They charge more for the loans that they lend out. When they take your money and they make your money go to work for them, they're making more than what they're paying you. Hence, they're making a spread. That's your goal, to make a spread. The downside of building your own banking system is really the same downside of building your own traditional bank. The first couple of years of running a bank, I'd have to believe, and I don't know this to be a fact, they probably lose money, just like every business. Most businesses lose money for the first 5 to 7 years. So there's a period where you're going to lose money. Just get over it. Like if you're an entrepreneur, you already know. You're like, oh, well, I lose money in my business for the first couple of years, but then I make money for the rest of my life with the business. Exact same concept. You're going to lose for a couple of years, and you're going to make for the rest of your life. If you're not willing to lose for a couple of years, 2-3 years, to make for the rest of your life, then this is not for you. That's another take to the person looking to explain this. So it's a great question. Sorry, I went a little bit far with that, but it's a good learning lesson, I guess.
So Chris, I think we can do one more quick math example for that question, because there's one more key piece that's going on in the calculations. Let's say that you take a $10,000 loan, you have a 5% interest rate. If you don't pay anything back throughout that year, guess what your interest charge is going to be?
$500.
$500, because 5% of the 10,000 is $500. So you would have paid $500 of interest to the insurance company. Now, if you're using that money to finance a car or whatever it is, you're going to be making payments back into your system. So let's just say you took a $10,000 loan, 5% interest rate from the insurance company, and you put $500 a month back into your policy loan repayments. What is your interest rate now going to be at the end of the year?
3.4%.
Chris, you know my numbers.
Say,
So
wow.
yeah, it's like 3.3%. And if you put in $800 a month, it goes down to like 2%. So the whole concept here is if you're an honest banker, you're not going to be paying 5%.
Yeah, I usually don't go there because that just blows people's minds and they're just not ready for it. You know, sometimes the truth hurts, or as in the Matrix, you can't. That's
You
the
can't
Matrix.
handle the truth.
You can't
Good
handle
men.
the truth. What was
A
that
few
from?
good men.
Few Good
Good
men.
men.
Yeah, you can't handle the truth, but that is the truth. All right, I
Good
think
movie.
we probably got time for 2 more Instagrams, and then we'll probably wrap with 1 or 2 more YouTube. So this is a good one. This is coming from Dr. Thomas here, DRTOMSON. Anyway, I have 3 IBC policies and have more money to put in, but it doesn't seem like there's room. In the first year, I was able to put in close to 10x the premium, but now it doesn't seem like much. This is so classic. Does anyone want to hit this? This is just a perfect question. I hope that the doctor, if that's what that insinuates, is still with us, because this is a very important thing.
I mean, what he's talking about, he's got a bank on, right? He's got his Main Street Bank, a 3rd Street Bank, a 5th Street Bank. It's time. He can't fit more into this.
Yep.
It's time to open another warehouse for his wealth. He's expanding his banking
Bingo.
legacy.
In just to kind of go fast, because I know we're at time. That's how it's supposed to work. So I know it's not cool. You want to put more money in, but you can't. That's because of the IRS rules, the MEC 7 pay rules. You're at your MEC limit, which is great. You're maximizing your policies. They're running as efficiently as possible. The first year you dumped a bunch of money in, but now you can't put much in. And all that means is, like Jason said, it's time to expand your banking warehouse. Branch office number 4 is ready to happen. All right. Great question. And also too, no pun intended, but hey, Sean has got it right there. If you're looking for another policy and you want us to help you design and build and manage your infinite banking concept, go to mentors.beyourownbanker.com. I sometimes forget to tell people, like, this is what we do day in and day out. This is all we do. So please, like, let us help you solve your problems. And we definitely do a very good job with that. When do I know I should open it? Oh, kind of already hit that. All right. There was another really good one, Sean. I want to hit one more. Right here, and this is Cam Hillman. When using the IBC concept for a business-owned policy, are interest payments on the loans tax deductible? This is a great question. We cannot give tax advice, so I do want to say we can't give legal or tax advice, but this is a pretty easy one. Do you think we can kind of just give this one to them?
You can say what you do. This is what we
yes,
do.
It's definitely tax deductible. We'll consult with your here's how I'll do it. Yes, it is tax deductible, but consult with your CPA for the final answer.
Chris, I can't believe you don't want to talk about Amir's. Hey, can't you do IBC through IUL?
Yeah, we should go a little bit long because I think we owe people 5 more minutes of our time because of our mishaps in the beginning. So I'm going to keep going here.
All right. Dude, Instagram's on fire. I wish I could have got to all these questions on Instagram. This is wild. There's like 10 more questions. But yeah, Shauna, it's all you now.
It's okay. So Nesmac Investments LLC is saying, where do we go to connect with your community for people who want to reach out to use their cash value to loan out for private lending purposes?
Chris, we'll go to you. Chris knows.
Privatemoneyclub.com. Privatemoneyclub.com.
Dating site for your money.
Perfect. Okay, and then another one. Amir is saying, I recently came across agents offering IBC through IUL policies. They recommended a book called Laser Funded. What are your thoughts about IBC using mutual IUL policies?
Chris, I finally, Chris, I used to think you were just angry. You're angry because you're in Buffalo and it's cold. When IUL questions came up, I would think that. And now I've had so many people come and ask me these questions, the same exact question, that I feel just like Chris. It hurts my soul. I get angry at the agents that are uneducated and they're trying to tell you. My question for you, Amir, is who do you want to be in control of the contract? When you have a contract, do you want to be the one that's in control of the contract, or you want someone else in control of the contract?
I have a new spin on it too. So Amir, if you ask any of these people on the screen how they use their whole life for IBC purposes, we have examples of how. I'd be curious to see if any of those people who are selling you IULs use them. How do you use them? What are you using them for? How are you doing them? I would ask them that question first. I feel like they're just selling. They're just a regular salesman selling.
Well, and to that point, Sean, I love that perspective. I would also ask him, can you show me the the original illustration and what they said it was going to do, and what does it look like now? Because those are typically two different pictures.
Very, very different. Now, IULs, Amir, always, we say this all the time, their illustrations are prettier. They're going to illustrate out better, more favorable. They're in color. They have all these cool things to it, but they suck. They don't work the way that people tell you they're going to work. And I had someone coming to me today with 2 4-year-old IUL policies. One has this much surrender value, cash value in it, and one has about what's been put into it. It has maybe 1/8 of what the cash value would be in a different design policy.
But Jason, it has a floor of 0. Woohoo!
Again, my question is, if you want to really know, go look this up. Go look what an insurance company can change in an IUL contract. They can change 2 things based on how profitable that is. And that change is not going to be favorable to whoever owns that IUL. Versus on a whole life side, you are the owner in a mutually owned company. Your contract is guaranteed to grow at a rate for the rest of your life, for your whole life, just as the name says.
So, Shauna, real quick, since we're up against time and this is a huge discussion, I put a link to Chris's IUL video in the private chat if you want to put that in there.
Got it.
And Amir, please watch Chris Kirkpatrick's stuff. You just got to understand. And I just stayed quiet because I just trying to just tame the beast inside. That's
Here's
all.
the other one.
Yeah,
Sean. Those are the 2.
Chris, you see, I brought it up because I get excited now that we bring those up. I know how you feel, and I get to see,
especially laser, like that laser book. That guy's gonna he'll absolutely be out of business, probably in jail. I know a lot about it, a lot. Hey, actually, can I just hit one on Instagram? I would like for Chris to take a look at my whole life policy and tell me what you think about it. Tree3REE. Absolutely. Send that over. I'll just do it to Shauna. Shauna at chrisnoggle.com. That's Shauna Shauna at chrisnoggle.com. Email us over your policy illustration, your in-force illustration. We're happy to look at that for you. All right. Well, with that being said, folks, thanks for joining us for another edition of Ask Me Anything's Happy Hour. We hope we got all your questions answered. Instagram, we thank you so much for your questions. They were freaking awesome. Sorry we didn't get to them all, but join us next week and we'll get them taken care of. You're welcome, Tree. Thank you, and we'll see you soon.